up ahead. Affirmative 612.
This week on the Wealthy Pilots podcast, are bonds back? And not James Bond or Barry Bonds or whatever other bond you can think of. But, Scott, it's now time to start thinking a little bit about bonds again, right? With the rates. I mean, yes and no. Like, I know there was just a small cut. We just had the little, quarter cut there. But I don't know. What's your thought? Are people kind of thinking in this direction again? Starting to see some buzz out there about that.
Yeah, I think when rates bubbled up in 2022, I think folks are starting to think like, hey, fixed income is going to have a lot more value in the future. And, to me, I think I'm not anti-bond. It just really depends on what's going on in the person's, I don't want to say in their life, but like in their financial planning life. Where are they at? And to me, I think the critical factor, the critical question to ask around if I should own bonds or not is, when do I need the money? Okay. When do I need the money? This is actually a big conversation that we have with clients around why I believe target date funds fall short on delivering good results for especially younger people. Because every year you own a target date fund, we sell our stocks and we buy our bonds. And if you dove into corporate America and you started to really understand balance sheets and debt to equity ratios and all those kind of things, debt is much safer for companies to own than equities, right? I mean, equities are much more volatile. You're an owner, right? And so because of that equity in a company, and what the company is doing, you're taking on more of the risk of owning a share than you are of issuing debt that somebody's going to pay back.
Yeah.
Right. Typically people, banks are pretty good at monitoring who they're giving their money to because they don't like bad debt. Right. And so it tends to be that issuing debt is going to be safer because people want to pay their debts back. And that's all a bond is. A bond is a debt between a corporate entity or a government with a promise to pay at a certain rate. And that rate is based off of the interest rates that the Fed is setting when they're issuing that money from certain banks. And so, to me, when we own bonds, I think people are feeling like I want to own bonds to be a little bit more safe. But there's risk in everything, right? If I'm in cash, I don't have really interest rate risk. I don't have stock market risk. If it's after tax cash in an account, I don't really have tax rate risk, but I have risk of inflation, right? So, if I'm in all Apple stock, I have a lot of equity risk in that one company. I'm not very diversified. If I have all of my money in tax deferred, I have a lot of tax rate risk. If I have all of my money in bonds, I have a lot of interest rate risk. And so a lot of our financial plan and a lot of our retirement plan is really just around managing risk. And so specific to this conversation around bonds, it's why I always like to ask, when do we need the money? Because if we don't need the money anytime soon, we don't really need to build that income plan. We need to focus on growth. And so if you're 55 years old, we need to start talking about the income plan. Well, assuming you're going to retire at 65. If you're under that age, typically we need to be focused on growth. Now, I will say one other part here that we need to understand is people's tolerance for volatility, I'll say. If you can't stomach your stocks dropping by 40 to 50%, once or twice in your working career, you might not be wired to be an equity investor because the data says in a 30-year working career, that's going to happen 1 to 2 times. So if you're going to flip out and go to cash, being a stock market investor might not be for you because candidly, you don't deserve to get the good returns because you're not willing to stick with it through the tough times. All right. That would drive somebody to be more of a bond investor too, because, hey, I know I'm going to get less returns, but I can stomach, it's got a lower downside as well. So
it's the boring income. right?
Yes.
Yeah.
Yes.
Yeah.
It's
Well,
that behavioral side.
I got a couple of quotes here. I'll throw a graphic up on the screen and just kind of let you respond to this. I got one from U.S. Bank here. Just tackle it, see what you think. To understand why opportunity exists in bonds in the second half of 2025, it's important to remember where bonds come from. A bond can deliver return to its owner from two sources: interest payments known as coupons, whose rate is set at the time the bond is issued, and changes in the price of the bond as it trades in the market. So, with that said, that's U.S. Bank, by the way. With that said, why does it get misunderstood? You explained some of that already, but I think people do feel like it's safe, boring income, which is what we've been told for 50 years. So that's why we kind of want to do that.
So, to me, that kind of feeds into where I said it's not that I don't like bonds, but when we're talking about growing a portfolio, versus generating income, it's two different goals. And so what I don't like about what I'll say a bond fund is like much like an equity or a stock fund. It's a pooled group of different bonds.
Right.
And that bond fund, especially held in some sort of 401k or something like that, is it's held more as an asset class than it is as an income producing tool. And so that bond fund really carries a lot of interest rate risk, right? Because, people are typically using that bond fund as just a diversification tool, and they're going to be rebalancing and what have you. What we'll do for folks that are closer to retirement, we will start to buy like a pooled, like a custom pooled asset base of specific bonds that the value of those might go up and down based off of what interest rates are doing.
Right.
But we always recommend you're going to hold those to maturity. And at the end of that period, so again, let's say I'm a pilot, I'm 60, I'm going to retire in 2030 at age 65. Okay.
Right.
We might sit down and like let's get your income mapped out from age 65 to 66, which is going to be a bunch of bonds that mature in 2030. So we'll get a pool of those bonds that are going to mature in 2030. Now, on paper, the value of those might go up or down based off of what's going on in the interest rate market or the stock market. The value of those on paper, but you kind of almost have to ignore that and just look at what is the coupon rate. If I'm getting 6% on those bonds, just hold the dang things and get the 6%. And then that's your income for 2030 to 2031, that first year of retirement.
Almost like a little bit of a ladder strategy, because you're thinking about this is just specifically this set of money 30 years from now, for example.
Yeah. And not even almost, just that is exactly what we call it, a bond ladder. And so we'll do that for 2030 to 2031, 31 to 32. And you go find those high quality bonds that are paying good rates, and you pull all those together in one little fund for somebody. And again, the value of that might go up or down, but you're more so focused on this is going to, and because it's, somewhat committed in that bond, assuming it's pretty good quality debt of high quality companies. I mean, I can't tell you the last time Apple defaulted on some of their bonds, but some of that debt is pretty safe. And that's where you want to be careful. Like if you look at high yield bonds, those are actually, or the phrase used to be called junk bonds, but now
they got a makeover. It sounds much nicer to say I've got a high yield bond, but it still trades under JNK, which is funny.
Exactly. Yeah, I got a high yield bond. It's like, well, the high yield bond just means it's got a significantly higher level of defaulting, and you could lose money
and risk. So, exactly. Yeah.
And so, if we're cleaning out some, and again, for income, I'm not trying to get increased yield to grow the portfolio. No, let's take that risk over on the equity side of the portfolio.
Yeah.
For income, I want you to feel really good that we got a really good chance to get all this income paid out to us. We're going to get high quality bonds from, top companies, government entities, et cetera. Pull that together. And now I got my income carved out for 2031. I got my income carved out for 2032. And so it's critical, especially if you got 5 years, if you're 60 and you're going to retire in 5 years, this is an exercise you want to be doing, and you can do it inside of your 401k, and you will take significantly less interest rate risk doing that than you will in some standard, 60-40 portfolio or a target date fund or something like that. So you can build that customized portfolio. And this is where, like, that last decade of your career, it's very important to start getting a little bit more engaged. You don't need to be in there every day, but we should have a good plan and know what is the job of each of these funds and each of these holdings. Okay.
Gotcha.
And so that's where for a lot of our younger folks, it's like, man, a target date fund just, the data doesn't really support it. Makes a lot of sense. And, when you think about what do I want to own, I want to be an owner. I'm not trying to like own debt. I want to own equity. I want to be an owner of a company that's going to hold. And think about it from the company's perspective. If I'm borrowing $1 million from a bank, okay, let's say I'm borrowing it at 5%. The expectation for me as a corporation is I'm going to go invest that $1 million and I'm going to earn something like probably 20%, 25%, whatever the case is. We're not borrowing the money at 5% to go make 5%.
Mm-hmm.
I mean, that's not what corporations are in business to do. They're in business to take that money that they're borrowing, use it as leverage to invest it in something else that's going to give them an increased return. And that's the profit, right? So if I made 20% and I owe the 5%, I got a 15% profit. And so to me, myself, most of my clients, we want to be the owners that are getting that higher percentage.
Gotcha.
If you're owning the debt, then you're just going to get what the debt pays. And so that's going to be lower, but it is safer. And so, that's where it's a little bit still comes back to like, what's your risk tolerance as an investor for the long haul? And then also what's your income plan for retirement?
So in building a strategy, how often is bonds in there in the current environment? I mean, it's like anything else. Sounds like it's going to be plan specific and person specific.
Yeah. And I think like the key takeaway for me here, if I had an action item, I mean, to me, if I'm younger with a long time horizon, it's checking my portfolio and making sure that I'm behaving like an owner and I'm trying to get that profit margin. Profits typically drive better returns, better looking earnings, the ability to pay dividends and invest in yourself. Like profits are good. I want to be an owner of a company who's making profits more than I want to be owner of debt, unless I need income sometime soon in the next 5 to 7 years. I probably want to start figuring out how do I get some income plan for me. And debt is a great way. Owning debt, corporate debt or government debt is a good way to get yourself some income that's going to slightly outpace inflation and take stock market risk out of that income. But, the numbers are going to be specific by person. And, and again, inside of the 401k, not in the stock 401k, you got to do a little work to get into that self-directed business. You can build those income plans out and just have it ready. So when you show up at 65, it's on a silver platter ready for you. You don't have to make all these elaborate decisions the last 12 months of your working career. You can just coast right into retirement.
There you go. So when you show up at 65, it's waiting for you on a tray. I like that.
That's
all right,
right,
folks, if you need some help, reach out to Scott. Get yourself onto the calendar, retireairlines.com. Click on the show links below in the show description, and that way you can get yourself some time onto the calendar. Don't forget to subscribe to us on Apple, Spotify, and, of course, YouTube to see if bonds is the correct part of your specific portfolio. Again, have those specific chats with a financial professional like Scott Osborn, who is the airline advisor at Patriot Wealth Planners. And don't forget, check out the toolkit as well. If you'd like to get a copy of that, that's a great way to get started. And we'll see you next time here on the podcast. Thanks for hanging out, buddy.
All right. See y'all soon.
Appreciate you. We'll see you next time here on the Wealthy Pilots Podcast with Scott Osborn.
Hey everyone, real quick, if you haven't grabbed Scott's Financial Flight Control Toolkit yet, now is the time. This is packed with tons of helpful resources and tools like this, Scott's book, The Dichotomy of Wealth, which is a pilot's guide to maximizing wealth and cash flow in retirement. You also get access to some great guides like this one, Advice Matters, which breaks down 4 key ways a good financial advisor can help you boost your returns over time. And guides like this one on the pitfalls of emotions when it comes to investing, and this one on the HCM byline investment strategy, and more. So if you'd like your very own Financial Flight Control Toolkit, just click the link in today's show description, and Scott and the team will be happy to get one sent your way at absolutely no cost to you.
Information is for illustrative purposes only and does not constitute tax, investment, or legal advice. Always consult with a qualified investment, legal, or tax professional before taking any action.